Welcome back. We had recently a very interesting question regarding the 10-1 yield spread, the direction, the depth of that spread, and the implications to the stock market trends. Really good question. And the question was essentially, we have here, for example, the red line's a 1-month T-bill, the 10-year bond is in blue. The question is if the long-term yields, such as the 10-year bond in this case, if those yields rise more than the short-term yields, or if the 10-year rises and the short-term yields rise as well, I'm paraphrasing the question, would that not be considered a good sign for the market, for the stock market, for the overall economy? And conversely, if both yields fell, would that not be considered to be a bad sign? It's a very, there's a lot of possible answers to this question. I'm going to try to tackle it one by one. First off, we know that the long-term bond yields, like the 10-year bond, for example, that gives us the long-term expectation as far as the economy. Very simply, if the economics look good, GDP is rising, growth, that sort of thing is rising. We say, well, what's the outlook for the near-term future? Not bad. If that continues, what's the outlook for the long-term future? Even better. And stocks tend to rise over time, and that's a good thing. And bond yields, of course, reflect the expectation of higher interest rates. Now remember, the bond yield competes with stocks. If we can get 8% return on a stock, and there's some sort of risk, obviously, taking a position in the stock market, we might be able to get a 5% yield in the bond market. If the stock market's going down, then traders are going to say, I'll take anything, as far as a guaranteed yield from the U.S. Treasury market. I'll even buy a 1% bond, because 1% guaranteed in U.S. Treasuries is a lot better than losing money in the stock market. So bond yields, the expectation of the economy and stocks all move in the same direction. Now, let's look back in history, because of course we never know what's going to happen, but we can use history as a guide. The yellow area chart is the S&P 500. The blue line is a 10-year bond. The red line is a 1-month T-bill. Now, sometimes we talk about the 1-year bond, and sometimes we talk about the 1-month T-bill. In my mind, they're both short-term securities, which reflect the more recent expectation about the economy, as opposed to the long term. We could say the 1 month versus the 10-year. We could say the 1 year versus a 20-year. As long as there's a gap to demonstrate between the short-term and long-term maturities, short-term and long-term expectations of the economy. And we can see, this is very interesting what happened in 2003. We go back, the stock market was S&P 500, was around 1,000. The 1-month T-bill paid around 1%. The blue line, the 10-year bond, paid around 3.5%, 4%. And this is what happened as stocks continued to rise, 2003, 2004, 5, and 6. The expectation for the short term was the Federal Reserve would continue to raise interest rates. Well, sorry, not that they would continue to raise interest rates. They would start to raise interest rates. No, actually, they were raising rates at this time. I stand corrected. Now, the long-term expectation about the economy was something different. The long-term expectation about the economy as well, things are great now, but things look a lot better in 2003 in terms of the long-term future. In 2004, still the long-term future looks better. But when we get to 2006, we say, well, things look great now, but things don't look that much better in 2007, 2009. We come to a point where things look so good now that they, by default, can't look that much better into the long-term future. And this is what happens when short-term expectations and long-term expectations meet. We have an inverted bond market, or the crossing of the yield. The short-term yield, the 1-month T-bill, crosses above the 10-year. That's when the short-term and long-term expectations meet. Now, we come to 2007. The 1-month T-bill in red now starts to go down. In this situation, the bond market and basically our expectations of economic growth begin to falter. And we see on the long term, things don't look so optimistic. On the short term, it looks like things are getting worse faster. And that's when the red line, the 1-month T-bill, crosses back below the 10-year and to the downside faster. Now, to answer your question was, what if in one scenario both bond yields decline? Well, that's exactly what we saw in late 07, early 2008. Stocks go down, and the short term goes down faster than the long term. The short term bond, like the 1-month T-bill, always will move faster than the long term because there's less time. Time gives us a possibility of something else happening. For those of you that are familiar in the options market, we know short-term option contracts. If you buy a call on a stock that's going to expire in 30 days, that stock option will be very volatile. The stock goes up 1 point, the option might go up by 1 point. If you buy a LEAP, a long-term option, a 1-year maturity option, well, the stock goes up $1, that long-term option might only go up by 10 cents because there's more time. Time makes things move slower in the short term because, the stock goes up $1, but it could do a lot in the next year. So it's not going to be so reactive. Short-term bonds act like short-term stock options. They're very reactive because they have to compensate for the near-term future because that's all it really has, is only the near-term future. Long-term financial instruments tend to move slower, and that's why the 1-month T-bill fell down that much faster. Now, and of course that coincides with dropping stocks as well. All this time, if you remember, we had lots of economic numbers. The Federal Reserve was meeting. There's lots of noise in between, these moves and these trends. But this is what was happening. Now, in 2009, we saw a flattening of the 1-month T-bill, and then the 10-year bond finally hit a low. This was 2012, early 2013. The 10-year came down to about a 1.5% level. Now, make a mental note. When we see a very strong economy, we will see this pattern again. The short-term maturity 1-month T-bill will stay right down near zero, and that indicates the interest rates for the time being will stay at zero, while the long-term maturities will go up and they'll go down, but we're going to see a very, very wide gap. We move forward now, 2016, 17 through 19, we see the same pattern again. Short-term 1-month T-bill goes up and meets the long-term. This is when things look good, even better, even better. Now things look so good in 2019 that the short-term meets the long-term. And then again, to address your question, both yields sink, and that brings us into 2019, 2020. Now, of course, I know March 2020, that was a huge violent sell-off as a result of the COVID crisis. But I would argue, even if it was not that catalyst, we were already setting up for a decline. That happened to be the reason why things happened so quickly. Now, fast forward a little bit further on in time, 2020 through 22, the same pattern again. Remember, the 1-month T-bill right near the low, and this shows us interest rates are at zero. See, this is what happens. It's very interesting. You have zero interest rates. How do we know? The 1-month T-bill right on the floor. It doesn't rise. The 1-month T-bill gives us the expectation for immediate interest rates. Immediately. Are interest rates going to go up? Nope, they're staying flat. The 10-year bond, the long-term maturity, gives us a long-term expectation of economic growth. Things are good. Things are getting better. Things look even better. Well, things begin to look so good that we see inflation. How does the Federal Reserve fight inflation? With higher interest rates. How do we know higher interest rates are coming? The 1-month T-bill tells us right here. February 2022, we can look back at our Federal Reserve decisions. This is the beginning of a lot of interest rate hikes that we've seen. Now, things look so good. Now we'll say, are things so good? Well, from an interest rate yield point of view, things are so good. And also stock markets, and we do see stock markets near the highs. Now, we could make a very, very strong fundamental argument that maybe things don't look as good as the stock market tells us. Jobs, salaries can't compete with the inflation rate. Well, that's the beauty in fundamental analysis, that there are many levels. And we'll definitely talk about those. Getting into much deeper into fundamental analysis on how strong the economy really is, or maybe not. But just from a pure bond market, the mechanics of the bond market point of view, it's the same type of pattern. We see the expectation. Forget about whether we think the economy is good or bad. That's more subjective. The bond market tells us the expectation of higher interest rates. Well, we see the same pattern. The short-term 1-month T-bill goes up, and the expectation eventually, when we have the beginning of the inverted bond market, which occurred mid-late 22, the 1 year actually crossed above in June. The 1 month crossed later on around October, November. That's the point when the bond market tells us that the expectation for higher interest rates is stronger in the near-term future and not in the long-term future. Here's another view of the current situation, starting in January through, May. We'll take a look at June in a second. The 1-month T-bill is the white line. The 1 year is the red. Those are the short-term securities. The 5 year is a light blue line, and the purple line is the 10-year. Now, the other half of the question is really a very good question, was that what if the 10-year bond yield rallies? Right now, we have the 10-year down here, 3.65 roughly. The 1 month is up near the 5.5. The 1 year is at around 5%, 4.92. What if we see a situation where the long-term yields rise? I don't know. When we study the patterns of the year 2000 and 2007, those obviously led to very devastating bear markets. I don't know, maybe it has happened. If anybody is familiar with a period of time where long-term yields actually, after an inverted bond market, recovered and we avoided the recession altogether, that would be a very interesting study. I can't think of offhand that happened. And that's one of the reasons, they have these articles, a lot of the different financial websites will talk about the fact that we can't avoid a soft landing. What's a soft landing? Where we enter a minor bear market, the stock market goes down a little, but then we recover and things get better. That's just not really the nature of markets. See, markets take a long time to go up and a short time to go down, in part because, bear markets are driven by fear, which arguably is a very strong emotion, much stronger than greed, which is the emotion that sends stocks up. If I tell you a stock's going up, we may buy, $1,000 worth of the stock, 1,000 shares. Not all of our money, we'll spend some money. But if I tell you the stock's going down, well, you're going to sell 100% of it right now. It's very rare that somebody would use all their money to buy the stock if it's going up, but you definitely would sell all your shares if you think it's going down. Traders and investors, people tend to react faster with bad news, and that's why markets go down that much faster than they go up. So the question is, is it possible for the long-term yields, like the 10-year over here, to go up? Well, yes, if anything, of course, is possible. What would we need to see that, though? We would need to see the expectation of long-term growth to really come back. But to come back in a gradual way where it would not necessarily spike the short-term interest rates, where the Federal Reserve would say, we're going to raise interest rates over time, but we're going to have to reach some sort of normalization first. Normalization meaning the 1 year and the 1 month, it's going to come down to parity with the long-term rates. I can't think of an example. Now, this does not mean that we're 100% predicting a tremendous bear market or recession. We don't know what the economy is going to look like, and we definitely don't know the timing. The timing is always the most difficult to predict. But we do know the market is following very similar patterns very similar to what we've seen in the past. In terms of past markets, let's first take a look at present present case where we are right now. The white line is the S&P 500. We see there's white and red histogram bars at the bottom, and this shows us the breakouts and breakdowns when they occur and to what degree, how much of a breakout. Now, how do we quantify how much? It means how many days back in history do we have to look to see the S&P 500 at a higher high or a lower low? Well, most recently, we saw the S&P 500 hit a level, this was June 12th, just the other day, hit a level where it read 298. Now, it's at 4,500 roughly, the S&P 500, 44. But 298 means we need to go back 298 calendar days in order to see the S&P 500 at a higher high. Almost a year. We have to go back to, maybe summer of last year, about, exactly 298 calendar days. The longer we have to go back in time to see a higher, lower, low indicates the greater, the more significant that breakout or breakdown is. We saw very, very big highs when the S&P 500 hit levels in January of 22. Those were very big highs, all-time highs. Now, we see 2007. This is 2007 to 09. The S&P 500 broke down. This was January of 2008. Hit lows we had not seen in 1,300 days. I'm sorry, no, that was S&P 500, 1,300, around 300 days. 333-day high, low. And that obviously led to a very significant low that eventually at 1273 broke down the lows we hadn't seen in over 300 days as well. Now eventually moved to the upside, and the S&P 500 hit 400-day highs April of 2010. And that really shows us when we see a breakout how significant that is. Well, this is where we are now. Again, we just hit on a close-up. We hit highs, 44.25. Those represent highs we haven't seen in about 300 days. 300 seems to be a pretty big level. Not all-time highs, but certainly very big highs. How does a one-year bond stand up? Well, the one-year bond actually very recently hit lows we had not seen in about 128 days. Now, before that, it did hit highs we hadn't seen 164 days. But the one-year Treasury kind of looks like it's going down these days. This is, and that was 2007, 2009. This is where we are now. And again, 2007 to 2009, that was the beginning, or I would say the middle parts of that very big recession, 2008, 2009. And that's something that's very representative of a bear market. The short-term bond yields just collapse. Well, this is where we are now. We've seen 5,000-day highs on the 1 year. So we're not breaking down yet. Here's the 10-year bond, 2007 to 2009, obviously going down, and then hit eventually lows we had not seen in, that's about 250, 300 days at that point. The 1 year bond hit much more significant lows though. Well, this is where the 10-year bond is now. We just hit highs, 69-day highs, not that big a deal. Notice the 1 year bond hit much more significant highs. The 1 month bond in 2007 through 09 hit really big lows, 242-day lows. Really got clobbered all the way down to zero. Well, this is where the 1 month bond is now. Most recently, it hit 4,600-day highs. That's decades. That's very, very big highs. So at this point, we see here, and this is the 1 year bond long term. This really zooms back to 2006. 2006, 7, the 1 year bond goes down, then has a huge breakout. Well, the 1 year bond breakout now dwarfs what happened in 2017. That shows you how much the Federal Reserve has raised rates. This is the 10-year bond. 2006, 7, not really a big until we see a huge breakdown when we hit lows. Those are 1,500-day lows. Well, the 10-year bond most recently hit 4,200-day highs. This is the 1-month bond, long term, going back to '06. Well, those interest rates in 2018 were pretty big. Those hit highs we had not seen in 3,400 days. Well, the 1-year bond, I'm sorry, the 1-month bond, March 2nd, hit 4,600-day highs. And this is the S&P 500 finally. We haven't surpassed those 2022 highs, but if and when we get back to those levels, a 4,800 level on S&P 500, that would tell us a lot. So the last charts we've seen just now show us that bond yields, when we see recessionary conditions, they go down and they break multi-year lows. I think that, and we look at a lot of charts, and a lot of them have bearish implications, but at least as of yet, it's telling us that we have very, very strong conditions at the moment. It doesn't mean those strong conditions can't change, but we know what those changes look like. Those changes could look like something we saw in 05, 6, 7, where short-term rates go up, cross above the long-term rates. Well, they've done that so far. But then we enter 07 through 09, where short-term rates cross back below the long-term. So to go back to the question as clearly as it possibly can, scenario number one, if yields drop, both yields on long and short-term securities drop, I believe that's a bear signal for the economy and for stock markets and for pretty much everything, because that tells us the expectation is that lower interest rates in the future. And it's very bearish if the 1 month or the 1 year, the very short-term securities, treasuries drop much faster than the long-term. Conversely, if we see a strengthening in long-term securities, long-term treasuries, I should say, like the 10-year, that would be overall very bullish, very positive for stock markets and our economy. So, we watch the spreads, and we watch to see not only the width between the spread between long and short-term treasuries, but also their overall direction, and also how they react to news. How do they react to the economic calendar? Federal Reserve decisions, non-farm payrolls, and everything else in between. So we're certainly at a very interesting point in our economy. We're gonna spend a lot of time watching this very closely. We hope this has been helpful. We look forward to seeing you back soon.